Awesome. Well, here we are. Rob, you're back. I want to welcome everyone back to another episode of Wicked Energy with JG. I'm sitting here with Rob Barnett, a gentleman that flew all the way from London, not to see me, I can promise you. But you're here. We're finally get to meet in person. It's been a while, and happy to see you, man. How you been?
Yeah, I've been doing well. It's really great to see you. It's good to be in America for a change, and it's also good to be here in Houston. I used to come to Houston a lot.
Okay.
When I was earlier in my career, since I've been living in London, it's more rare for me to come here, but it's always lovely to be in Texas.
I'm sure, and so because you were in the U.S. not too long ago, relatively speaking, for some vacation. Orlando, was it?
Yep,
Yeah.
I did Orlando last August.
Okay.
I actually came through Houston in December. It was too rushed, or else I would have said hello then. So
I would imagine that based off of your experience in the years that you've been in the industry, when you go to certain cities, there's probably a long list of people that you could reach out to, and it's either you reach out to all of them or just none at all, and then you may stumble across them every once in a while. So to be on the list, I'm absolutely honored. I don't know how I managed to make the list, but I appreciate you reaching out. How long are you in town for?
Just a couple of days. I'm flying out on Wednesday, so this is a pretty brief trip for me this time.
No kidding.
Got some other obligations in New York City later this week, and
nice.
And we have quite a big customer base there. So
absolutely,
got to go see the energy finance people of the world there.
I'm sure everyone's just looking forward to some guidance from Rob here after what's been going on lately. So I have to ask, what is most exciting to you right now in energy markets? Like, what's exciting? Just something you just can't get off of.
Well, there's so much. I mean, I think in the very short run, it's hard not to pay attention to what's going on in the banking world, right? I think I'd never heard of Silicon Valley Bank a few weeks ago, or maybe heard it in passing once or twice. I do have some friends who work in the tech industry, and I think had heard mention of it from them in the past, but not anything that I'd ever thought much about. And to suddenly go from, now we're suddenly talking about Silicon Valley Bank, and then watching so many of the energy exposed and commodity exposed industries, companies kind of really take a pretty big hit here from that is quite interesting.
Yeah.
So, I mean, in the very short run, just kind of paying attention to what's happening in the banking world and thinking through, is the pullback in oil price, something that's because there's this very tangible hit on demand that could be coming because of a banking failure, or is it because oil and other things in the market are just simply kind of all asset classes are just moving together, and so what's going on? Is there effect on the fundamentals, or are the fundamentals sound? And so I think right now that's sort of the very immediate question on my mind, and I think a lot of our customers' minds. But then longer term, it's all about kind of what's the right mix. We get the sense that the world's changing. There's all of this stuff around energy transition, all very exciting. At the same time, fossil fuel demand has been very resilient and growing in most instances. So you've got a world where wind, solar, electric vehicles, all these things are growing super fast, but so is demand for fossil fuels. So we're in this kind of really interesting time period where all of the above used to be a term that get thrown around, but I think we are truly in this all of the above era.
Yeah.
And that's also fascinating. So we've got the near-term banking situation that's affecting all markets, including energy markets, and we've got this energy transition backdrop to it all, which shows it's a great time to be in energy.
It is. I think, like you said, all of the above was kind of that loose term to say, oh yeah, I'm kind of for everything. But now I think it looking at it, I think that the reality is it's going to, and I don't think anyone argued that at any point in time, but I think the extremists on either side, you're hearing less and less of them, and I think there's a lot more constructive and healthy conversation about, okay, now that we've gotten, my ideologies out of the way and your ideology out of the way, like, let's look at the fundamentals, the facts, the science to understand, like, hey, because ultimately, like you said, energy demand is not going anywhere. Oil demand obviously is pretty strong. We've got, all this talks about China and all the demand that they're going to be, putting into the market. A lot of, non-OECD countries. I mean, unless this whole this banking thing just completely creates a bunch of demand destruction, which I don't know, may or may not happen. I'm curious on the banking side. Do you think we're sort of at a point where we're okay, and do you think this is going to be a domino effect, I guess is what I'm saying? And could it be? I mean, I don't know the banking world enough to be like, well, now that this has happened, all the rest of them are going to, fault or sell off. But yeah, I mean, what are your thoughts around that? Are we at the ninth inning in this short little flash in the pan, or is this just the start of a...
Yeah, I mean, well, even though I work in the industry I work in, I think mostly about energy and fundamentals for energy markets.
Yeah.
So I think I'm definitely like an interloper to say anything about the sort of broader finance world. But clearly, governments around the world seem to be racing to kind of calm the markets, put the backstops in place to sort of stop the contagion and stop the crisis. So let's see whether they're successful. And I don't have a good sense on whether, we're sort of over the hump or whether there's more dominoes to fall. That's something that I would say, well, let's just see what happens on the market front.
Right.
But what I would say, if you think about oil, which is pretty interesting, right? If you go back and look at all of the recessions, whether the global financial crisis or just in general over the last few decades, the biggest hit to oil demand in any significant way was COVID, and that was steep. We've never seen anything like that, even when we've had a financial crisis in the past. So I think oil demand generally doesn't fall more than a few percent, even when you have a recession, at least at the global level, right? So, my sense would be that while the demand impacts aren't necessarily going to be zero, it would be surprising, I think, to most observers if it was anywhere close to sort of a COVID level disruption.
For sure. No, I would agree. And that was one thing that when this whole recession fear, which I think is somewhat still there, and this week is a big week for here in the U.S., whether or not they actually increase interest rates, whether they pause or whether they hold back. And, there's everyone's kind of on edge waiting to see what happens. But for us in the world that I play in, being oilfield services, which is directly tied to rig count and to oil prices and all the rest of it, looking at a recession, trying to forecast, okay, if a recession hits, what does the crystal ball say for rig count? And it was interesting because I didn't realize that it really doesn't make a huge dent. So they call it 3% on a 100 million a day consumption globally. That's not that much, right? It's which was interesting to hear. I'm curious on a little bit of a pivot, but we're talking about all of the above, and the reality is we need a lot of all of it. Is the investment community looking at, with oil and gas companies and the returns that they've seen, is the investment community is shifting at all? Do you think we're going to be able to get, and I say we as an oil and gas, are going to get money from outside, or are we just going to have to fund this ourselves? Because I think it's interesting, because for the last while, it's, we're underinvested and we don't have the capacity to ramp up, and so all the oil bulls are like rah rah rah. Do you see that shifting at all relative to their peers, for lack of better terms?
Yeah, so I think there is this real phenomena that's happened in the industry that there appears to have been underinvestment, particularly following COVID, right? And so it's really tough to say how much investment is required to meet the demand for energy, partly because the efficiency of investment has arguably improved a lot because of shale. So
Interesting. Yeah.
how many billions of dollars need to be invested just to keep oil supply flat, right? Like it's a pretty big number.
Yeah.
But it's and sort of pegging where that number is should be or could be, it looks really different today than pre-shale discovery,
right?
Because you can deploy a lot less capital for reliable volumes, essentially, in some markets now because of that innovation. And so, but with all of that said, I think you're seeing a very clear pivot in Europe right now, where you've got BPs and other companies saying that they're going to allocate more CapEx to traditional E&P investment in 2023 and for some of the coming years.
Interesting.
And I would argue that is not really a substantial U-turn on any of their transition thinking, right? So
Gotcha.
The European oil majors, or energy majors as they want to be known, are really thinking about a very different future, and they are planning to really change some of their capital allocations over the coming years. Now, in the short run, they have decided, hey, look at what's going on with oil and gas, and so they're putting more CapEx to play there in the short run. But I don't think they're abandoning any of their long-term visions about how the energy sector is going to unfold over, say, a 3-decade time period.
Gotcha.
So there is some sense that some of the European majors and perhaps elsewhere need to invest more, and that they are planning to invest more, at least to help meet short-term energy needs. And let's see whether that actually comes to fruition or not. But there seems to be trickling through into planning and CapEx budgets.
Interesting. Is that more to please investors, or is it more to meet energy demand, or a combination of both?
Yeah, well, I mean, I would say it's a bit of both, right? The European energy majors have been under a very different set of pressures from investors that I think has been slowly coming over to the U.S. And there's this really interesting debate happening here right now, because the ESG has become almost a bad word in many circles, and you're seeing Ron DeSantis in Florida and some of the other presidential hopefuls talk about ESG as sort of a cause of many of the problems that the world is facing. And I'll take no real stance on whether that's right or wrong, but just to say that European investors have been putting like an ESG lens on the European energy companies for some time.
Yeah.
And what that really means is that ESG for oil companies is about managing your carbon footprint, reducing your carbon footprint over time, or setting the aspirations for doing that, and kind of what does that mean, and all these sorts of questions. And so I think the European energy majors are a bit ahead of perhaps their North American counterparts in terms of really thinking about that and having a plan for that. I will say one other thing that's very interesting and ironic to bring it back to the banking conversation. I think Silicon Valley Bank was a company that a lot of ESG investors were quite fond of, right?
So interesting. Okay.
Because they were a big funder of, community solar and climate startups and all of these kinds of things. And so most of, or quite a large number of the ESG funds in Europe had Silicon Valley Bank as an investment, right? So it is kind of an interesting world in which we live, and whether it's Shell, BP, Equinor, Total, these companies also have quite a bit of ESG disclosures as well, and so they also participate in those conversations. But the one so do Exxon and Chevron, right? There's all kinds. I think nowadays it's really hard to not have any answer on ESG. And the guy who runs our department here at Bloomberg is quite fond of saying, in the next few years, all analysts are going to do a bit of ESG in their work. So we're traditionally mostly like financial analysts, industry analysts, people who have some knowledge about the markets and fundamentals. But increasingly, we get asked a lot of ESG related questions, and so we've got to be more sophisticated in understanding that part of the story and how it feeds into the sort of total investment thesis for at least for some investors.
So on the ESG front, do you think either the E, the S, or the G has more weight than the other one when we're talking about like looking at it, like you said, on Bloomberg's side? Is it mainly focused on the environmental piece and sustainability, I guess?
I mean, I think ESG has mostly been about E for the energy companies.
Yeah.
But that being said, it's not in general. It's not for a lot of investors. I think here in the U.S., there's this really interesting debate about, and I don't know whether you'll even know the answer to this, but some of the largest ESG funds in North America, which stock do you think they'd have a preference for, Tesla or Exxon?
I'm gonna say Exxon.
Yeah, and it is interesting. So a number of the ESG funds that are focused on the North American market do hold Exxon, partly for their disclosures and things like that, and a number of them don't hold Tesla, and mainly for the G component, right? Because I think for the governance issue, a lot of it has to do with board composition, how powerful is the CEO, this kind of stuff, and and I think my understanding is that's where Tesla might get knocked, even though they are very prominent and important on the E side of the equation. So ESG definitely, in theory and on paper, doesn't mean that it's a company that's only focused on carbon or managing that, right? But I think in the past, a lot of investors maybe would have sort of rounded it to that, but I'm not so sure that simple answer is the correct one.
Yeah, no kidding. I want to pivot, and we were talking about the European majors. Do you think Shell will actually move their headquarters? Because I saw that kind of floating around, and I don't know if it was just like comical relief, but was that actually a thing?
Well, there are some proposals that have been put out by financial market participants that suggest that have indicated that BP and Shell should consider moving their headquarters to North America. And I believe Shell's new CEO, according to FT reporting, is that they at least thought about it or considered it, and they ultimately decided not to,
right?
Because they recently moved their headquarters to London, if you recall.
Yeah.
And but the basic argument would be that that ESG investment framework has put a lot of conditions on European energy majors or oil majors that don't allow them to thrive. And that if they move to North America, they would get a better reception from the general investor base. And I don't know if you've ever looked at it, but generally speaking, if you look at a valuation perspective, so like an EV to EBITDA multiple, whatever your favorite valuation metric is, the European oil majors tend to trade at a significant discount to the U.S. oil majors, right? And so there's all kinds of theories as to why that happens.
Interesting.
But one of the reasons, or one of the speculations for why that discount might exist is because of sort of the ESG pressure or whatever. And so if those companies were to change their headquarters to North America, I guess the theory would be that maybe they could have a they may not get that sort of discount because they're dealing with all the sort of European ESG investors or whatever. Who knows, right? Like it's not clear that would necessarily be the answer, but that investors are looking for. But I think that's sort of in the back of the mind of some of the people who've been making that argument. And yeah, we'll see. I mean, obviously they have big operations and footprints in North America already.
Exactly. Yeah. No, it's I have some I don't have necessarily the background or experience or knowledge on the financial world to understand why, but off the top of my head, to me, it's like, oh, they want a little taste of what they can get over here, I guess. I don't particularly know, but do you suspect at some point? And I thought if it would have happened, I thought it would have happened already, but I was willing to bet that one of the U.S. oil majors would have ended up buying some of the one or two of the European majors. Do you think that's a plausible thing to happen? Or
I mean, let's see, right? I mean, I've seen, just like you, I've seen that there has been speculation about that for years, right? And part of it is because of the valuation discount as to why I think people would speculate that there's a potential for that. But I think the question is, how does the market want people to deploy their cash and capital? And I have no idea whether that's the sort of right answer. I mean, I think a lot of it would come down to kind of like asset portfolio of any of the European majors and whether it would be sort of a nice fit with any of the U.S. ones. But the other thing too is, the European majors have been investing in electric charging infrastructure and wind generation facilities and things like that. And would any of the U.S. companies want that? Because they have explicitly really taken a different perspective on those kinds of questions.
And it's interesting looking at what, when you talk about the new energy stuff, it's the U.S. oil majors have looked at the carbon capture stuff and been heavy on that, whereas the Europeans have looked at, like you said, the charging stations and the offshore wind and everything else. And so definitely a little bit of different strategy there. But again, there would have to be some synergies and some reasons why, not just because they can. Right.
And BP's got a very significant solar PV pipeline as well, and so they're really building out quite a bit of solar over the next 3 to 5 years. So, and that's an interesting piece of their strategy, right? And not. No, I don't have a strong view on whether one company's strategy is better than the others, right?
Sure.
That's investors are constantly evaluating that. Yeah. But if any of the U.S. companies were to be interested, they're not like for like entities, right? Because they really have quite a different sort of strategic plan in place in the European side. Yeah.
No, thinking of Shell actually was interesting. So I was on Instagram and they created so there's Shell Energy is an arm of Shell, and I saw on Instagram a pretty unique ad for electricity for here in Texas. They're getting into the utility game, and so I reached out out of the blue. I said, "Hey, I'm so and so. I have an energy podcast. I would love to hear more about Shell Energy and what you guys are doing here in Texas." And they actually reached back out, and so I'm going to have some Shell Energy folks on to talk about what they're doing on that front, because I had no idea. They're into all sorts of stuff. It's pretty wild.
Yeah, and the really interesting question there that I think we don't know the answer to yet is the business model for utilities and oil companies has been really pretty different over time, and just generally speaking, utility returns tend to be lower.
Okay.
Right? Stable but lower, right? And so the question that I think no one knows the answer to is that, well, if oil companies do take on more and more assets that are utility-like, are those utility-like assets going to have a lower return over a long duration? Mm-hmm. Or are the oil and gas companies going to figure out a way to offer better returns in a space that utilities have played in for decades and not been able to find a better set of returns to offer to their investors? And so we don't really know the answer to that. But if you look on Shell or BP, when they talk about this question, they do talk about the differentiation and expected return for some of those investments versus some of their, say, upstream investments.
Right. Because isn't a company, I don't know if it's pronounced correctly, but ENI or ENI, don't they play in like all sorts of different arenas when it comes to utilities? And then they're obviously an oil and gas company as well. And I mean, I remember reading some stuff a couple years ago, and then when I saw the Shell Energy thing, I was like, wow, it must be a European thing, because I'm not buying electricity from Exxon or Chevron, or you know what I mean. So it's just an interesting sort of a philosophy. Switching gears a little bit, I'm curious on the natural gas market side of things, mainly in Europe. Are we seeing reaching the floor closely to gas market, the gas prices out there, or do you think there's more room? I mean, what are your sort of thoughts around European gas markets right now?
Yeah, so for anyone who doesn't pay super close attention to the European gas market, prices went just atmospheric after Russia invaded Ukraine, and we're down at this point, I think more than 70% since the peak that we touched last year, but we're still trading at a quite elevated level versus Russia's invasion of Ukraine or pre-pandemic, however you want to kind of think about it. So, but prices on a dollar per MMBTU basis are in the neighborhood of $14 per MMBTU versus $2 and change here in the U.S. So gas is pretty expensive. As for whether we've kind of found the bottom yet, well, like I said, we're still elevated versus that pre-pandemic or pre-invasion level. And I think really the market's going to be tight from a fundamentals perspective, because Russia played an incredibly important role in supplying gas into Europe, and their exports of gas to Europe they're not zero, but there's very close to zero. Wow. I mean, we've the taps did get turned off last year, and there's so many factors that have really helped the market find its balance. So we did have a very mild winter, which was a blessing for making sure that the gas market didn't get super tight in the winter. Yeah. At the same time, U.S. really ramped up LNG exports very substantially to Europe over the last 12 months. Mm-hmm. We have seen a pretty healthy amount of demand destruction from industrial activity, the big players deciding to potentially move assets into North America or other markets, or figuring out ways to rely on other sources of energy, right? So a lot of gas is used to create heat for processes, right? Yeah. And so you can, in some instances, it's possible to even use coal to create that heat. And my understanding is that some companies actually went back to using coal this last in an industrial setting. This over the last 12 months, we've certainly seen more coal being used in the power sector as well in Europe. So there's just this entire mix of things that have happened to help the European gas market find its balance. But the really interesting thing is similar to the U.S. There is gas storage in Europe, and we're essentially entering the exiting the winter sort of peak demand season with very high levels of storage
which is
in
unusual,
place.
right?
Right.
And that was and that was because of the weather.
Right.
A good chance of it, and along with people obviously the demand coming down.
And so, over the next, call it 6 months or whatever, that there will be efforts to refill that storage for the coming winter and things like that. But and so we don't exactly know how that is going to play out. But if we have a hot summer, that'll make refilling the storage more challenging. If there's any hiccups on the LNG side, or if demand is more robust, we just don't know. But so the market, I guess what I would try to say is that we've come through a very difficult 12 months in terms of it's been all a crisis, essentially, all hands on deck to kind of how does Europe make it through this, losing a massive amount of supply overnight, and we've gotten through that 12 months. But then next winter could be as challenging or even more difficult than the past winter was, if the weather doesn't go in our favor or whatever. So this is going to take a few more years to probably sort out. So I do think from a supply demand perspective, we see the market as looking tight for quite a bit more time.
Yeah. So how does the deployment of, say, solar and wind, and mainly on the electricity generation side of things, is that helping offset the demand in natural gas? Is it enough to move the needle, or is it still slow and steady? And I mean, how does that come into play?
Yeah. So solar and wind, I think, are key components of the sort of energy strategy in Europe, and possibly could play a role in helping to sort of tamp down on power sector gas demand. Some other things that matter there, though, would just be, I don't know if you followed the nuclear situation in France, but they've had a pretty troubled year. So with all of the things going on, a number of the nuclear reactors in France were down for maintenance, safety issues, things like that. And so nuclear output was lower this year than I think most would have expected. And so despite all of that, we still made it through the winter, and we are where we are today. But you could think of maybe the fact that nuclear wasn't high relative to what expectations would have been. The grid operators are doing all kinds of things, and coal was burning more as well in the power sector. And so, all in, I mean, every solar electron or wind electron that you put on the grid is probably means one less electron that's got to come from gas or coal, some combination of those two.
Right. Because
I think nuclear and the others are sort of outside of your control a little bit. If a nuclear power plant has to be down for maintenance, that's never something you can say, oh, let's just delay it or whatever. Typically, you got to do it because there's like this strong safety element there.
Yeah.
So, if we're in a world where nuclear is kind of more robust in Europe, and the next wind or solar build out that's going to happen this year and next year, well, is it going to get rid of gas, or is it going to get rid of coal? A little bit of both, perhaps, would probably be the answer, because coal did come back up because it was sort of backfilling for gas. So maybe the sort of deployment of those don't explicitly reduce gas too much, but they might reduce coal instead, which is an objective of the European governments over there. They want to get coal out of the mix as quickly as possible.
Gotcha. Do you follow coal prices at all, or know where they stand relative to history?
Yeah, coal has been an elevated commodity as well. So I believe that we're below highs that we touched last year, but at least in Europe, coal prices went up quite a bit alongside gas and oil and other commodities, following Russia's invasion of Ukraine.
Wow.
And I know that one of my colleagues covers Glencore, and Glencore is one of the big diversified miners, but they've been, doing quite well on the coal side of their business over the last 12 months, even though I think themselves and many of the other miners have sort of set a plan in place that by 2050 they're going to reach net zero or whatever, that kind of thing. So I assume that coal eventually falls out of their portfolios. But for now, coal has been a bright spot for some of the companies like that. And
I'm sure.
It has been more expensive to use it for sure.
Yeah. What? So talking about Europe, where, like, as we are today, where do they get most of the gas from? Like import wise.
Yeah. So with Russia, so prior to Russia's invasion of Ukraine, Russia was the number one supplier. Norway was the number two supplier.
Okay.
Now Norway is the largest gas supplier in Europe, and Equinor plays a big role in that. And and then I think after that you've got some North Sea production in the UK, and then you've got some gas supplies coming from North Africa. You've got LNG imports. You've got some gas flows coming from Azerbaijan and other places like that, and kind of the more far eastern parts of Europe.
Yeah.
But by far, it's Norway at the moment, and then I believe LNG might be number two, actually, which has but that's a diverse set of countries of origin. It's not all from the U.S. or whatever, but if you counted that as a block, it's suddenly gone to be a very important piece of the overall balance. And and let's see how it goes. I mean, our view though is that Russia is not coming back though, right? So
right, which is I think a fair kind of assumption and sort of way to look at it, right? It's a safe bet to think that, and then if all of a sudden not, then even better. But it's crazy to think how markets fix themselves or find ways to overcome just the chaos, because for a while everyone was like, the world's coming to an end, like Europe's just, everyone's gonna freeze to death, and then here we are, like warm winter, they get enough gas, now all of a sudden they have more storage than what they thought they'd ever have, and it's just like, how did we do this? But we find a way.
Yeah, no, indeed. And I think it's kind of funny to think Germany is a successful industrial economy, and if it's not as if these kinds of crises occur and everyone just throws their hands up in the air and just says, I don't know what we're going to do. I mean, and I think a lot of serious people put their heads down and sort of thought about, well, what do we need to do to get through this? So, yeah, it's been pretty interesting. I mean, I'm curious to hear your perspective on North America's role in all of this, because I think one of the surprising pieces is how quickly U.S. almost sort of came to the rescue with LNG. But my sense is that on the liquefaction side of the equation, that the U.S. is kind of probably maxed out for now and doesn't have a whole lot of ability to sort of grow it much more quickly here in the short run. Is that how you would see it?
Yeah.
You think that's the sort of right view?
Yeah, I don't know how much more capacity we have to export, like, as of today. Now there's, I think, 3 major liquefaction plants coming online over the next few years, or I say few, up maybe the next 5, sort of staggering at which they're going to be completed. But when you look at like folks like Toby Rice and a lot of the big pro natural gas folks that play in that world, I think it's going to play a critical role for just overall, because I guess it depends on, and I've heard kind of 2 schools of thought, is like, we always talk about peak oil demand. But what does peak natural gas demand look like? I mean, are we going to have to continue to untap and increase export capacity to where, like it doubles in the next 10 years? Or are we going to get to a point where all of a sudden everyone has, for us to export, most of our stuff's going overseas, right? So is all of a sudden that part of the world going to have enough gas in that part of the world to where then the U.S. is going to sit on their own, and then gas prices are going to go super low, which is not terrible, and then energy security comes into play. But again, and I'm by no stretch of the imagination an energy markets expert, but I try and pay attention enough, and I know that like you look at the Haynesville and the Marcellus, it has the potential to alleviate a lot of stress when it comes to supplying a relatively cheap gas for us here domestically, and to the rest of the world. And when you look at sort of from a climate perspective, there's argument that it's not actually that clean. However, it's cleaner than a lot of the alternatives. To where then is it that bridge fuel? I know that's been a term that's been thrown around. Some people hate it. Some people still use it. But I say all that to say, I mean, I think the U.S. plays a major role in helping with a lot of the headache that we've experienced, to hopefully help stabilize markets, I think would be a fair way to say it. And then here in the U.S., for us, especially if we look at like a lot of industrial, if we can bring a lot of it from offshore here and being able to, because like a lot of the natural gas, there's a lot of feedstock that goes into that. So if those prices can remain low, then hopefully that helps drive down costs for us to manufacture our own goods here. Because right now that's a challenge. Whenever you bring things domestically, especially on the chemical side, which is the sandbox I play in, a lot of times it's more expensive. So if we can drive down costs because we sit on a lot of cheap gas for industrial, I think that helps us. So that's kind of my 2 cents. And if we can drill for more, then that helps me because rig count is good.
I'm curious. So obviously, when you frack a well, drill a well, you get some. You probably get some mix of gas and oil in the output. And
yeah,
given where Henry Hub pricing is at, if a company's out executing a drilling plan and they come up with a higher gas weighting, are they almost disappointed right now, given where gas price is relative to oil, or how does that play into it? I mean, can I guess my question is, can you make good money at Henry Hub being $2-3 per MMBTU? Does it need to be higher?
So it's very area specific, right? It's basin specific. Now, if you talk to, I think up in the Northeast, the Marcellus, I think that low twos is kind of that break even point. So folks right now are still in the position to make money, obviously not as much. Haynesville, I think, is a little higher. But when you look at like Eagle Ford and Permian, where there's associated gas, Permian, they don't know what to do with the gas. There's not enough takeaway capacity. So again, it's very area specific. But you take, for instance, say an operator has a drilling program where they have acreage that on this part of the field is heavy oil, and then on this, or like more oil focused, and then on this side it's more gas focused. A lot of times they're just going to reduce activity until they can get it back. Because I know, from my personal experience working with a certain operator, once gas got below $3, they right away changed their drilling program because at that point the economics don't make sense. So again, I think it's very operator specific. It's very basin specific. I'm not exposed to that, typically, but I do know that when gas was high, a lot of that associated gas that people were actually able to sell, it was awesome. But for the most part, I don't think I think these gas prices are enough to control activity levels on the downside, which ultimately we're starting to see, which I say we're starting to see. Last week, I think we saw 8 rigs get added to the board. And it's funny, since oil's gone down, well, obviously oil's gone down and gas has gone down, you're not seeing, I think you're going to see the rig count impact, but there's a lag there. Because as gas went down, we've actually seen an increase in gas rig count, because typically it's 80-20 here in the U.S. 80% oil-focused rigs, 20% gas-focused rigs. Now it's 21% gas-focused rigs. So we actually got a little bump there. Now, I'm sure that'll all balance out, but it's interesting because it's not directly correlated, even though you'd think it would be. But knowing what I know about people's drilling plans, they're actively making plans to slow down a little bit on activity, especially if you're exposed to gas. So
it's really interesting. And I mean, I know we got to sort of find a stopping point here pretty soon, but I was going to say, let's circle back on the bridge fuel idea. And I'll tell you that at least in Europe, I think gas is not seen as a bridge fuel anymore.
Okay.
Given what's happened with Russia, Ukraine, whereas I think it still has a great potential to be that here in North America because of the abundant shale resource and quite a sort of good pricing environment, right? Gas is just too expensive to be seen and too potentially subject to geopolitical risk in Europe to be seen as a sort of reliable bridge fuel. Right now in Europe, let's see whether these plans actually pan out a lot, but there's a lot of emphasis on hydrogen. And, I think that's still kind of quite abstract, and we're not really at the project realization phase of any of that. But I think they're putting a lot of eggs into the basket of sort of pairing electrolyzers with renewables that can produce hydrogen, and that will be sort of a key component of industrial energy needs. But we'll see.
Okay. Well, last question then before we close out. We'll tie it up with this one. What emerging technology do you know of that is really interesting to you that is not quite getting the attention that you see having a bit of more impact than what the public may anticipate? Anything special?
I mean,
that interests you?
Yeah, I mean, it's in some ways I think that we can kind of see where the energy complex is headed. And so I think the future is going to have quite a bit of renewables at this point, and wind and solar. But then I think the question is, what are they going to get paired with? Because renewables are great at providing energy, but they're not, it's only available when the resource is available. And so, is it during the daytime or is it when the wind is blowing?
Yeah.
And so clearly there will be other components of the energy matrix. And I think we're still trying to figure out what those will be. There are a lot of folks who say, well, it's going to be nuclear, or it's going to be hydrogen, or it's going to be carbon capture and storage. And I think that we really don't know. But for the longest time, some people would have said it's going to be some kind of advanced biofuel, right? And I think Exxon worked with Craig Ventnor and synthetic genomics for a number of years on kind of advanced biofuels, and I don't know where any of that stands. But the point is that there is clearly going to be, I think, some kind of storage medium or energy supply that we don't really know for sure which one it's going to be. And so I think that's interesting to sort of say, is it going to be nuclear? Is it going to be hydrogen? And which one's really going to sort of rise to the equation to match with the kind of things that are a bit more sort of happening and known at this point. And I don't know the answer to those, but I'm certainly watching with curiosity, and I'll probably take views on them on occasion. But
that's okay.
Yeah.
Awesome. Well, look, this has been a great conversation, Rob. I'm so happy we could meet here at the Bloomberg office.
Yeah.
Appreciate the hospitality. For all the listeners out there, please make sure you connect with Rob. Heavy on Twitter. I'll put the link in the show notes. Or your handle in the show notes, and then you obviously have your YouTube channel, which you're very active on now, which I'm pumped to see.
We're gonna put this there as well. So
awesome! I'd love to see it. And then TikTok. Are you on TikTok?
I'm not on TikTok.
Okay.
Well, I'm basically not on TikTok. I think I used it once, and it was fun.
Yeah,
but it's a bit. I think I'm 20 years too old.
Never. No, that's. Hey, you know what? My mom said that about Facebook, and now she spends more time on Facebook than any other platform. So I wouldn't go quite that far. And look, all listeners, thank you very much. Appreciate all the support. Until next time, take care for now. Thanks again for listening to another episode of Wicked Energy with JG. And look, if you or your organization wants to start a podcast, please visit my website and sign up for a free guide on how to start a successful podcast. Once you get through it, let me know if you have any questions or getting started. Thanks, and we'll see you next week. Peace.